Okay, so, everyone's always talking about how multinational companies, uh, kind of get away with stuff when it comes to taxes,
Yeah,
right? And all these loopholes and policies are constantly shifting.
right.
But underneath all that, it's really crazy how much comes down to something so basic currency.
Hmm.
And, specifically, we're talking about the US dollar.
The US dollar.
Yeah.
Yeah, it's really fascinating how it's like this underlying foundation for so much of the way international corporate tax works.
Yeah.
So many global transactions happen in dollars, they get reported in dollars, but its actual impact on tax liabilities and, how companies plan things strategically,
Right.
it kind of gets overlooked sometimes.
For sure. So in this deep dive, let's unpack how these multinational corporations are dealing with all the complexity of tax and regulatory compliance,
Right.
with the US dollar at the center of it all.
Sounds good.
We'll dig into the strategies that CFOs use,
Okay.
the whole world of offshore structures and transfer pricing, and how companies are adapting to all these ever-changing global tax policies.
Yeah.
And yeah, as always, we're going to try to make this clear and understandable
Absolutely.
and, avoid all that confusing jargon.
Exactly. I think if we can connect all this to the bigger picture,
Yeah.
you'll start to see how the dollar's unique position,
Yeah.
it doesn't just affect the bottom line.
Hmm.
It really shapes how these big global companies actually organize themselves,
Right.
how they manage their finances across different countries.
So let's start with how big the US dollar really is globally.
Okay.
Because, it's not just any currency, right?
No, not at all. The U.S. dollar is in a really dominant position, both historically and today.
Hmm.
It's the most used currency for international transactions.
Wow.
Whether we're talking about trading goods, investments across borders, even pricing commodities,
Yeah.
it's the go-to currency globally.
And I don't think it happened overnight.
Right.
I was reading that it kind of took over from another major currency.
You're right, after World War II.
Okay.
The Bretton Woods Agreement basically made the dollar the main global reserve currency,
Okay.
taking over from the pound sterling.
Interesting.
And unlike some currencies that might be tied to the value of another currency or a commodity like gold,
Yeah.
the U.S. dollar is a free-floating currency.
Right.
Its value goes up and down based on market forces.
Which, gives it a really wide reach, right? It's not just the official currency of the U.S.
Exactly. The U.S. dollar is officially used in several other countries.
Hmm.
And maybe even more importantly, it's the de facto currency in a lot more.
Wow.
If you look at Wikipedia, it says you'll find Federal Reserve notes being used in economies all over the world,
Yeah.
way beyond U.S. borders.
It's kind of hard to wrap your head around how influential it really is.
Yeah.
And how it's defined has changed a lot too, right? I vaguely remember something about it being linked to precious metals at some point.
Yes, the definition of the U.S. dollar has definitely evolved.
Okay.
Originally, it was tied to both silver and gold under what's called a bimetallic standard.
Right.
Then the Gold Standard Act of 1900 officially linked it just to gold.
Okay.
Even that link was changed in 1934.
Yeah.
And finally, in 1971, all ties to gold were cut completely.
Wow.
So now the U.S. dollar is a fiat currency.
Okay.
Its value is based on public trust and what the government says rather
Yeah.
than any actual physical commodity.
Mm.
This shift to a trust-based system.
Yeah.
It means that how stable people think the dollar is and global confidence in the U.S. economy,
Right.
those become the really crucial factors that CFOs need to keep an eye on,
Yeah.
especially for long-term tax planning,
Okay.
instead of relying on a physical asset like gold.
So we've established that the dollar is this massive free-floating thing
Yes.
that's used pretty much everywhere.
Uh-huh.
How does this actually affect the complicated world of multinational corporate taxes?
Okay.
Because let's face it, tax laws are already a headache even within one country.
You've got a point there. Multinational corporations have to deal with all these different tax laws and regulations across all the places they operate.
Right.
That's complex enough on its own.
Yeah.
And then you add in the constant ups and downs of currency exchange rates.
Right.
And it gets amplified even more.
And I imagine when you're dealing with the dominant global currency, the US dollar,
Right.
those fluctuations can have a huge impact.
Exactly, because so many international transactions are priced and settled in U.S. dollars.
Yeah.
Any big rise or fall in its value compared to other currencies
Yeah.
can directly and significantly affect a corporation's taxable income and their overall profitability in different countries.
So let's say a CFO based in Japan.
Okay.
They have to constantly think about the yen-dollar exchange rate.
Yes.
when they're figuring out their global tax strategy.
Absolutely. They need to strategically manage those currency fluctuations
Right.
as a fundamental part of their overall tax planning and risk management.
So these exchange rate movements,
Yes.
they're a crucial thing that CFOs must factor into their financial models and decisions.
That's right. And while we can't offer specific tax advice,
Right.
the general idea is that CFOs need to think about these movements.
Okay, makes sense. Now let's get into something that often sounds a little mysterious.
Okay.
Offshore structures.
All right.
How does the US dollar usually play into that?
At a high level, multinational corporations use offshore structures for all sorts of legitimate business reasons.
Okay.
Managing international operations, getting into global capital markets,
Yeah.
and yes, optimizing their tax situations legally.
Right.
Transactions within these structures, even if they involve companies not in the U.S.,
Yeah.
are very often done in U.S. dollars.
I'm guessing that's because it's so widely accepted in international trade.
Exactly.
It just makes things easier when different parts of a company in different countries are doing business with each other.
Exactly. The dollar is widely accepted, and it has deep and liquid markets,
Right.
which makes it super convenient and practical for internal transactions between different parts of the same multinational corporation, even if those entities are based in countries with their own local currencies.
But then the tax implications of all these dollar transactions happening in these offshore structures,
Yeah,
that's where things get really complicated.
absolutely. You're spot on.
Yeah.
The tax implications of those dollar-denominated transactions in offshore structures are subject to specific
Right.
and often complicated regulations of every country involved.
Oh, wow.
This creates a whole new level of complexity
Yeah.
because each country has its own rules
Okay.
on how those transactions are taxed,
Right.
when they need to be reported, what documentation is needed.
So you have these offshore entities often doing business in US dollars
Yes.
because it's easy for international transactions.
Right.
But then each country where these entities are registered or doing business has its own tax rules on how to treat those dollar profits and losses.
Wow.
It's a huge challenge to make sure they comply with global tax laws and don't get taxed twice. So it's not as simple as just moving money around in dollars through offshore entities.
Right.
And assuming everything will be fine tax-wise,
Yep.
there are all these layers of international tax law that come into play.
Exactly.
Yeah.
The U.S. dollar might make the actual transactions easier,
Yeah.
but it doesn't simplify those underlying tax obligations across different legal systems.
Okay, let's shift gears a little and talk about transfer pricing.
Right.
This is another thing that sounds very technical.
Yeah.
But it's super important for multinational companies.
Definitely.
How does the US dollar usually factor into transfer pricing practices?
Transfer pricing, in the simplest terms, is setting prices for goods, services, and intangible assets when they're transferred between related companies within the same multinational corporation. Think of a U.S.-based company that invents a valuable patent
Okay.
and then lets its subsidiary in Ireland use that patent to make things.
Yeah.
The fee or royalty that the Irish subsidiary pays to the U.S. parent company for using that patent is a transfer price.
And these internal transactions they often done in US dollars too?
Very often, yes.
Okay.
Because the U.S. dollar is so common in international business.
Yeah.
These internal transactions, selling goods, providing services, licensing intellectual property, they're often done and documented in U.S. dollars,
Okay.
even if the companies involved actually use different currencies in their day-to-day operations.
I see.
Let me give you an example.
Yeah.
Imagine a U.S. software company licensing its technology to its Irish subsidiary.
Okay.
If they set the price for this internal transfer in U.S. dollars,
Yeah.
both the U.S. and Irish tax authorities are going to scrutinize whether that dollar price reflects fair market value, regardless of how much it actually costs to develop the technology in the U.S.
Right.
or how much revenue it might generate in Ireland.
So if the parent company in one country sells something to its subsidiary in another,
Yeah,
they might just use dollars to keep things consistent in their global accounting.
that's a big reason. It gives them a single unit of account for the whole organization.
Yeah.
But tax authorities in both the sending and receiving countries are going to look at these transfer prices very carefully.
Right.
Their main goal is to make sure that multinationals aren't shifting profits artificially
Okay.
from countries with higher taxes to countries with lower taxes by manipulating these internal prices.
Does the US dollar's stability, or at least the idea that it's stable compared to some other currencies,
Yeah,
play a role when tax authorities are examining these transfer prices?
it definitely can. in some cases,
Okay.
compared to other currencies that a multinational company might be using.
Yeah.
The U.S. dollar might be seen as more stable and predictable.
Okay.
This perceived stability can influence how companies decide on their transfer pricing policies
Mm.
and how tax authorities judge those policies during audits.
Okay.
They might ask questions if pricing in a seemingly stable currency like the dollar
Yeah.
doesn't match the actual economic realities or market conditions in the countries where the business is happening. Right.
Especially if the real costs or market values are more closely linked to a less stable currency.
So even the seemingly simple choice of using the U.S. dollar for internal transactions
Right.
can raise red flags with tax authorities
Exactly.
if it doesn't reflect the true economics of the situation.
It's all part of the complex and often delicate balancing act of international tax compliance.
Now, the global tax landscape is always changing, right?
Yes.
There are new policies and regulations all the time.
Mm-hmm.
How do these changes affect how multinationals handle all these dollar transactions and their tax reporting obligations?
The fact that international tax policies and regulations are always in flux creates a constant challenge for multinational corporations.
Okay.
Changes in these policies, whether they're big multilateral agreements or
Right.
specific changes within individual countries, can directly and significantly impact how companies need to account for and report their dollar transactions. So a new international tax rule could suddenly change how a dollar transaction between two subsidiaries in different countries is treated for tax purposes.
Precisely. And because the U.S. dollar is so central to global commerce,
Right.
these policy shifts often have a really big effect on activities done in dollars.
CFOs and their tax departments must be on their toes all the time,
Yes.
staying updated on the latest regulatory changes and pronouncements.
Absolutely.
Sounds like a never-ending process of adapting.
It really is. They have to continuously adapt their tax strategies,
Okay.
their accounting systems,
Mm-hmm.
and their reporting processes
Yeah.
to make sure they stay fully compliant with the newest rules,
Right.
always remembering how important the U.S. dollar is in their international operations.
So this brings us back to the title of this deep dive.
Okay.
The currency factor most CFOs ignore during tax season, based on what we've talked about.
Yeah.
What do you think this often overlooked factor is? Is it just that the U.S. dollar is involved in so many parts of international tax?
It's more about being proactive, about managing the U.S. dollar's huge influence when it's the peak of tax season.
Yeah.
Many CFOs and their tax teams are naturally focused on compliance and reporting,
Right.
making sure all the forms are filled out correctly and sent in on time.
Getting those filings done and avoiding penalties.
Exactly.
That's the immediate pressure.
Right. But what can sometimes get overlooked during that busy time
Yeah.
is the need to really understand and strategically manage how the U.S. dollar's dominance in their offshore structures and transfer pricing activities really shapes their overall tax optimization and potential financial risks. It's not just about recording dollar amounts correctly at the end of the year.
Right.
It's about actively managing the dollar's impact throughout the entire year.
So it's not the CFOs don't know about the dollar's role,
Right.
but maybe they aren't fully understanding or strategically addressing its wider implications
No.
beyond just the basic accounting of dollar transactions.
I think that's a really sharp way to put it. If they have a proactive and deep understanding of how the dollar influences these core international tax elements,
Yeah.
it can lead to more effective long-term tax optimization,
Right.
better ways to reduce potential risks,
Okay.
and ultimately fewer nasty surprises during tax audits. It's about seeing the dollar not just as a neutral way to exchange money,
Yeah.
but as a crucial factor that actively shapes their entire international tax landscape.
Okay, so to sum up, we've seen how the U.S. dollar's position as the main global currency is at the heart of so much in international corporate tax.
Yes.
Its widespread use in offshore structures and transfer pricing, while it offers consistency,
Right.
also adds layers of complexity because of all the different international tax laws.
Exactly.
And with global tax policies changing all the time,
Yeah.
it's crucial for CFOs to keep thinking about and strategically managing the dollar's central role in their overall plans.
Absolutely. Understanding these dynamics really well isn't just a theoretical exercise.
Right.
It's absolutely key for multinational corporations to navigate the complex and constantly changing global tax environment
Yeah.
and to ensure their long-term financial health.
So for those of you listening, think about this.
Okay.
As global economies become more interconnected,
Yeah.
and things potentially shift with the U.S. dollar's global position, or even with the emergence of new international monetary policies in the future.
Right.
How might all this reshape the world of corporate tax? What new challenges and maybe even unexpected opportunities could come up for multinational CFOs directly because of these wider global financial changes?
That's a great question.
It's a crucial area to keep in mind as the world of international finance keeps evolving.